Mr. Chairman, you and I both know that way back when, and we assume 21, that there was a decision made by the Fed that gets close to quantitative easing and then the term tapering. And we know that it was sold as a monetary stimulus to help the country, and I get that. There was about, in my opinion, $2.33 trillion that were taken out in loans. And Chairman just spoke a minute ago about the term debt versus growth. Debt versus growth, about this amount of money that sits out there on the debt side. Could you please take a minute and discuss this issue and how we should be looking at it? Thank you.
Sorry, Mr. Sessions, are we talking about asset purchases that we made during the...
We are. We're talking about when the Fed went and sold treasuries.
No, we bought treasuries.
Bought treasuries.
Yeah, we bought treasuries. So, it was a situation... I'll tell you why we did it. We were just out of the worst part of the pandemic, and we didn't know how good things were going to be, how strong the economy. We were very concerned. COVID is still raging, and it actually, had a very strong wave right into 22. But we wanted to we didn't want to stop buying treasuries too soon, because that has a stimulative effect on the economy, because we didn't want to provoke an unwanted tightening in financial conditions at a time when we thought the economy was still vulnerable. You look back in hindsight, we probably could have done that earlier and halted purchase earlier. In any case, we turned right around and started shrinking the balance sheet, and
you moved it from about 120 a month to 110.
But we're down now. We've been tapering for 2 years now, and we're down more than $2 trillion. So, and we're still going. So that's why we did what we did.
Tell me what that looks like in the longer term aggregate versus with what the chairman said, debt versus growth, because we believe the debt remains and the growth is not equaling that ability to pay it back.
So what happens is we borrow money to cover the spending that Congress has done. Our purchases don't affect that. We're basically issuing reserves, which is cash, and we're retiring Treasury securities. And the effect of that is to drive down long-term rates. That's the whole reason for QE.
And what are you paying for those long-term rates?
Market rates. We're paying exactly the market.
And what would that market be approximately a year ago or to now?
Well, the 10-year, we're not, of course, we're going in the other direction now. We're shrinking now, but we are buying, the 10-year was yielding a very, very low yield, and it was quite low during the pandemic, extremely low, because, growth was slow. There was a lot of demand for treasuries. So we were pushing down rates to support economic activity. That's when you can't lower your policy rate anymore and you want to do more stimulus, that's really the main thing you can do. It's actually the forefather of that was Milton Friedman, who came up with that thought way back in the past. But that's what we did. And then, as I mentioned, we turned around as soon as we lifted off and started raising rates. We immediately started shrinking the balance sheet, and we've shrunk it a lot, $2 trillion and still counting.
You have shrunk it $2 trillion?
Yes, we have.
Okay. And what do you believe remains, and you believe you're now stable for moving forward?
So I think we have a ways to go. The level of reserves, which is the thing we're focused on, hasn't really changed. All of that has come out of what's called the overnight reverse repo facility. I'd be happy to spend some time with you on this. This stuff is very complicated.
I ain't gonna lie, I'm getting cooked.
Hearing on February 24th here in this same room, frankly via Zoom for a lot of people because it was in the height of COVID. And during my 5 minutes, you felt confident that inflation being at 1.4% would stay under control, and it wouldn't be an issue despite the very large increase in the supply of money. We talked about M2. In a subsequent meeting, frankly, in my office, we discussed Milton Friedman's quantity theory of money and depth, and you believed that it was no longer relevant, that inflation would not hit consumers. We debated asset prices during the hearing, and you claimed that the Federal Reserve's massive purchases of treasuries did not distort the market. Lastly, during the Biden administration, you were actively calling for more fiscal stimulus at times. And at some point along the way, more dollars chasing fewer goods seems to have actually resulted in higher prices. All of these things, inflated money supply, inflated asset prices, inflated consumer prices, happened on your watch. In light of the actual outcomes, have your views changed?
Well, I think we've learned a lot, but maybe not the lessons you think. But I do think we've learned a lot from the situation. We and essentially all of mainstream macroeconomics thought that this would be transitory, and and what that meant was it would go away fairly quickly as the supply side healed and as demand came down. And it didn't. It actually did go away, and substantially for those reasons. But it took 2 years.
And to that point, you felt like in the fall that it was going away and things were going to be under control, and you had achieved your soft landing. But the market pretty quickly spoke. I mean, frankly, rates went up over 100 basis points where you guys were going down. And now in today's reports, we see that inflation's actually trending up quite a bit from where it was in the fall. So again, would you, in light of the facts, would you reassess what you're doing with the central planning?
You're right that long-term rates went up, but they did not go up because of expectations of higher inflation. There's no evidence of that. It's actually different things. It's not about inflation.
Well,
look at markets. Markets are pricing in break-evens. I'll show you the. So
chart. the markets don't believe there's increased risk with massive fiscal spending in the market, and they're not demanding a higher premium because there's more risk.
More risk, yes, but not more risk of. It's not mainly about.
And when you see asset price inflation and rate inflation, doesn't that result in consumer price inflation?
It's not a question of that. You're saying that the rate increases at the long end are caused by expectations of higher inflation.
They certainly influence the inflation.
Not true.
And if they don't influence the inflation, why do you guys try to steer inflation by controlling the rates? I mean, the reality is you've got pressure, including from the president, to lower rates. Are you going to be able to get lower inflation with lower interest rates?
I think our policy's in a good place. I think inflation has come down from high levels to 2.6% last year. My colleagues and I are holding where we are, awaiting further evidence of inflation.
A lot of the data that you guys are looking at lagged, just like when you said it was 1.4% and everything's fine. I think a lot of people said, it's not fine. You got to go out and talk to regular people. And constituents in Southwest Ohio, just like all over the country, aren't saying they're fine. And they might go that the rate of increase has slowed down a bit, but they know that the prices aren't going down. They're still getting hit pretty hard. And meanwhile, you guys still continue some of these policies. Like you're paying banks still not to put their capital at risk in the market. Interest on excess reserves going back prior to the 08-09 financial crisis, you didn't even pay banks for reserves. Now you're paying them for an unlimited amount of reserves that they want to hold on it. To what extent is that distorting the market by pulling capital out of the market?
None, not at all. You're right, though. People are unhappy about the price level, and that's what we need is several years of real wages moving up higher than inflation.
Okay, so if they're having no impact at all, why is the Fed paying the interest? What is the rationale for the policy? Is it monetary policy or is it regulatory policy? Because as Chairman Barr pointed out, you guys are effectively gold-plating the standards, and the U.S. is actually holding way more reserves than we're required to. And part of that is IOER.
So, what's your question?
If it's not distorting the market, what's the purpose for doing it? What if it has no impact on the market? Why are you doing it?
It's the way we control. It's the way we exercise interest rate control in the market. I didn't say it doesn't.
Because it has an impact, and so I will have questions for the record, and I yield back.
I ain't gonna lie, I'm getting cooked.
American families were hit with a huge stealth tax from, as we've spoken about, inflation that drove up grocery prices and led to high rates on things like mortgages and car loans. Since 2021, the average Missouri household is paying about $1,100 more per month due to inflation. To put that number into perspective, the median family income in Missouri is $69,000. These families have had to spend $13,000 more of their annual income on the exact same goods. What specifically is the Federal Reserve's plan for making life easier for everyday Americans?
So the best thing we can do for Americans is to vigorously pursue both stable prices and maximum employment. We're trying to get back to a long expansion where prices are stable around 2%.
You seem to be there on labor, as you've pointed out. So tell me what else.
Sorry?
You seem to be there on labor. So what else?
I would say we're close, but not there on inflation. And you did see today's inflation print, which says the same thing. I mean, we've made great progress toward 2%. Last year, inflation was 2.6%. So great progress, but we're not quite there yet. So we want to keep policy restrictive for now, so that we can see.
We're definitely not there for 30-year mortgages. Upwards of 7%.
The CPI goes up, or CPE, excuse me.
Well, if inflation goes up in general, forget about tariffs. In general, of course, we will use our tools, which is the interest rate, to bring it back down to 2% over time.
Okay. Yesterday, you told the Senate we're going to release the stress test scenarios before we implement them. Will you take a holistic look at large bank capital requirements, including the risk-based capital ratios like Basel III Endgame stress testing, to make sure that you don't have a contraction in the ability of credit to Main Street businesses?
Yes.
Great. There's a proposal in Project 2025 that we abolish Fannie and Freddie. If there was no explicit or implicit federal guarantee for those who invest in mortgages, would that lead to higher mortgage interest rates?
Since you'd no longer be borrowing on the credit of the United States, in other words, so Fannie and Freddie would be privately funded, it could lead to that. I think privatizing Freddie and Fannie might have other virtues too, though, as has been considered many times by this committee and others.
Might have some virtues, but it would lead to higher mortgage rates.
It could.
Welcome to the Crypto Teacher. And I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And make sure you're joining the Patrons. If you're not a part of the Patrons, make sure you're hitting the Cash App. And also, guys, make sure you go like and follow the TikTok. More videos to come. And we had Jerome Powell in the house again today. And he was forced to say all that money printing helped manipulate the markets, buying up treasuries. And guys, we know anytime they're admitting the truth, something is around the corner. And when I was listening to this, I said, oh, they're cooking up something. Something is cooking behind that curtain. And remember, the Crypto Teacher told you. And he stated that, yes, treasuries are coming down. And he talked about the repo. But what did he leave out? He left off that balance sheet. It's still at $6.8 trillion. So the $2 trillion he was talking about was that emergency repo they were doing and not the balance sheet. And that's why he stated things are still high. That balance sheet really hasn't moved. And what did Jerome Powell say? It's complicated. But guys, I go over with you on a daily basis. Remember, this is the reason why they don't teach finances in school. Because if they did, none of this would work. And then he's asked about inflation. When inflation was below 2%, remember, it was transitory, so they could keep printing this money. And when it comes to the economy, it's definitely a lag. And that's the reason why we keep getting these high CPI numbers. And then also corporate greed. We know it's a handful of companies that own everything. The illusion of choice. And remember, the Crypto Teacher told you. And then we have teamwork makes the dream work. Elon Musk says the goal is high productivity, creating a better living for everyone. But what is he talking about? That's going to go over a lot of people's head. You're going from low productivity to high productivity. How are you doing that? You're going from humanity to the machines, where the robots, algorithms, and drones take over the economy, pay each other with crypto, and the sheep go inside the metaverse. And then Trump says, get rid of the Board of Education. And guys, a quick history lesson. Don't forget it was created by Andrew Johnson. And then, of course, Jimmy Carter made it an agency. But after Andrew Johnson created, about 40 years later, Rockefeller created the General Education Board so he could steer education. And who's doing that now? That's right, Bill Gates. Rockefeller wanted workers. Now, guys, because we no longer need workers, now you can start getting rid of us. Return it back to the state. And remember, the crypto teacher told you. And then we have the Fed. Yes, yield rates are going to continue to rise, but we know Scott Bessent is at the Treasury. And we also know he's a hedge fund guy, a George Soros guy, so he has plenty of ammunition that he can use to manipulate these yields. Only thing we have to do is get our popcorn, sit back, and let it play out. We know the goal. They want to destroy this legacy market so Trump can build this fourth industrial revolution. Remember, crypto means hidden message, hidden meaning. These cryptos are for the machines. And remember, the crypto teacher told you, because he knows when it comes to the NWO, it's all planned out. You have a wonderful day.
Are low to negative productivity to high productivity roles. And so increase the total output of goods and services, which means that there's a higher standard of living available for everyone. That's the actual goal.
Elon Musk mapping out plans. Elon Musk mapping out plans.
How soon do you want the Department of Education to be closed?
Oh, I'd like it to be closed immediately. Look, the Department of Education's a big con job. We're ranked, so they rank the top 40 countries in the world. We're ranked number 40th. But we're ranked number 1 in one department, costs per pupil. So we spend more per pupil than any other country in the world, but we're ranked number 40.
The prospect that rates will be higher for longer, that maybe inflation could be stickier for longer. Guy.
Today, yes, absolutely. I'm surprised. Again, if you had told me what would have happened, it would have been S&P's down 100 handles, easy given a run. You know, Karen, I think it was last week, Thursday, maybe said she was short the TLT. She basically top-ticked it. It's gone down ever since. And if you look at that trend line that we talked about in the TLT, since September, that downtrend is intact, meaning I think yields continue to go higher. What does that mean? Well, I don't think it's particularly favorable for markets. Again, I'm surprised the market behaved as it did, but it's just a matter of time before rates become a huge headwind.
The list the first time around where they were calling it transitory, and there was a group of us, including myself, saying there's no chance this is transitory. And when they figured out it wasn't, you had a problem because then they had to play catch up. And if you think about it, CPI ended 2021 at 7%. It ended 2022 at 6.5, but the S&P was down 19. So it comes down to, when does Jerome Powell go, I might have a problem, because CPI has now gone up for 4 prints in a row in terms of headline. Core PCE, which is what they focus on, bottomed in June. It's been going up since then, not in a straight line, but it's higher. And all the 4 measures of inflation, core PCE, CPI, core CPI, et cetera, all of that either bottomed in June or in the third quarter and has been going up. So I'm going to be very curious to see if Powell makes the same mistake twice. I don't think he will.
Going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
But every stock, every bond, every currency, every commodity, every piece of art, every private business, every piece of real estate will eventually be a token on a blockchain, an entry on a ledger, permanent and immutable. We will have truth instead of trust, and we will save over $7 trillion a year. 6 to 8% of global GDP is wasted by the friction of the trust industry that's necessary when you have dual entry accounting. With triple entry accounting, which is what a blockchain is, we get rid of all of that friction. It's a beautiful future.
Like what you see in China and their social credit scoring systems, right? If we get identity wrong, it could be a tool to enslave humanity. And if we get it right, it could be a tool to liberate humanity. And as an American, I'm obviously rooting for the one that's on the side of freedom.
Bitcoin is an international asset. And also, I do believe